right, guys, here we go again with another of our Evolution Consulting market update videos. This one being recorded on the 16th of March 2017, just after trading hours, about 5 o'clock. It's kind of a combination market and info update video. Again, we do not do too many of these, so we try to stuff as much into them as we possibly can. That being said, also, real quick, guys, by the time you see this video, Wirehouse subscribers, you will have your copy of the February edition of Wirehouse. It is right there. It's actually on that machine over there. We do apologize again about the delay, but we have had a tremendous amount of other work that we've had to do for our primary projects that we work on, proprietary research, corporate stuff like that. We did warn you. We said, we're going to keep trying to do the information sharing thing for as long as we possibly can, as long as it's feasible, and as long as we're able to make sure that the presentation is commensurate with the quality of information that we're sharing. So we do hope you guys understand that. Welcome to life on the cutting edge of technology. Okay, there are going to be those months where we're going to be a little late with the delivery. Try to make sure it doesn't happen. We'll get the March edition out in March, thankfully, so we'll be all caught up. So no problemo there, so to speak. That being said, guys, the reason we chose to do this video now is because, well, the last 48 hours have been friggin' eventful, yeah? It's kind of wild, and, and I truly hope, that our readers and listeners, they're smarter than that, but, you guys don't construe what I'm saying as arrogant, okay, or maybe smug. We'll freely admit smug, but certainly not arrogant, guys. But when we sit down and we watch some of these forecasts that we make, especially as it pertains to Fed policy, happen right in front of us, months after, weeks after, but in some cases, in this instance, years after we made the forecast, they all kind of play out almost letter for letter, even linguistically. Listen to the press conference afterwards from the FOMC. Even afterwards, seeing the linguistics and seeing those forecasts play out so identically to what we forecast, guys, it's freaking awe-inspiring, okay? Even as the senior system architect of the evolution programs, guys, I have a hard time not sitting back on what the hell did we build here? And I mean that in a very good way. But nonetheless, guys, for those of you that may have been following along since we did our very first test of concept phase in 2013, 2014, guys, we started talking about Fed irrelevance back then. Pretty much in the context and the time frame that we're seeing it happening. Okay, we said there would come a point where the Fed would lose control of U.S. domestic monetary policy. We realized that makes for great alt news headlines, and it makes for, fantastic discussion or fantastic intellectual fodder. It also makes for handy hashtag Fed irrelevance. But, excuse me, until you see it really start to happen, and you start to see from an economics mechanics component, you really start to see that happen. It's just that, guys. It's a hashtag, it's ideology, or whatever you want to call it. What we're seeing now, okay, with the dollar implosion, that really happened? Yes, it did. And the metals and the markets rally in the face of another Fed 25 basis point rate hike. We had a conversation with one of our customers recently who happens to be a hell of a nice guy. And we've gone well above and beyond trying to explain what's going on in terms of the political and the socioeconomic and the geoeconomic component of what the Fed is doing. And we said they're in a very dangerous position right now, the Federal Reserve is. If they go big, and we presented this as an option, switch and signal, they can go big, they can go a 50 basis point hike, they can go a 75 basis point hike, hell, they can go a 100 basis point hike. As a matter of fact, I'm paraphrasing myself from the most recent market update video we did. We said exactly that, which is, go ahead, hike rates all you want. It's not going to make a difference. It's to quote Mr. Sereni, our technical analyst, okay, it's that quarter turn on a bolt on a fire hydrant that's been open for weeks. The street's already flooded. It's too late. Turning the bolt this much or that much it doesn't make a difference. Too late. Some people use the analogy, it's like bailing out the QE2 with a shot glass, and that would be fairly accurate. Okay? But what we're seeing now is the consequence of 10 years of ZIRP, 10 years of TARP and QE1, QE2, QE3, okay, stimulus, bailout, and 6 million other programs. What we're seeing now, guys, is the consequence of that. All that liquidity has been hidden away, especially during the Obama administration. I'm going to go over this as quickly as I possibly can, but during the Obama administration, it wasn't okay to be rich. It wasn't okay to be wealthy. Corporations and banks and lenders and wealthy individuals kind of hid away for a little bit, and they just went, okay, we'll just, conspicuous consumption is out of fashion, okay, just, in the words of a wonderful gentleman I worked with in the boat business when I sold luxury yachts, Nick, act casual. And that's exactly what the investment class and the wealthy class in this nation have been doing, guys, for the last 8 years. Act casual, Be cool. Don't draw any attention to yourself. Well, fortunately, as we forecasted, Trump won the election. And again, as political atheists, we called it. We said, even the levels that we're at now, almost 21,000, like 20,800, 20,900, those range. He's not going to be the worst thing that's ever happened to capital markets. Okay, he's not. And now we're seeing the proof of that. Sustained. It's not just a temporary euphoria rally. It's a sustained long-term euphoria rally is what's going on. All right, but the reality of the situation is, guys, all that money had to go somewhere. Be that offshore, be that into demand black holes like Euroclear or wherever they went, guys, that liquidity is there. As Trump turns around and makes, cap gains taxes and corporate taxes and wealthy individual taxes, he makes it more feasible for wealthy individuals to start onshoring their cash again, okay, which was hidden away for the Obama administration, right? That money's got to go somewhere, and we've done pieces on that before in a lot of our publications. That's going right into the real economy, folks, all right? And that's just all there is to it. So the amount of liquidity that's out there, 0.25 basis points, 0.50 basis points, 100 basis points, guys, it doesn't make a difference anymore. And when we talk about the Federal Reserve losing control of inflation, again, that makes a great title of an article for The Economist or for any other publication you might read. But when we talk about that, we're watching it happen now. Okay, and as someone who studied economics for quite some time, that's pretty damn interesting to me, is to actually watch the mechanics of a central bank, the Federal Reserve, lose control of domestic monetary policy, because right now they're skating a bit of an Occam's razor, okay, if you will. And that is, as we said in Wirehouse, and we said in Switch and Signal, it's, what are you going to do? You're gonna hike 25 basis points, market's going to run in your face, metals are going to run in your face, all right? And you're going to go, oh, well, maybe we need to hike a little bit more. They're doing, it's either, it's death by 1,000 knives or just get it over with. And apparently what the Fed has chosen is death by 1,000 knives, which is, you're going to hike 25 basis points. Markets don't care, metals don't care, as we forecasted. And we're going to hike another 25 basis points. You're going to go with the back-to-back, approach, which is kind of what we forecasted in Switch and Signal. Be my guest, it's going to do the same thing. There's too much liquidity. There's too much money being onshored now, and there is also another variable. We talk about this in Switch and Signal, guys. Perhaps the ultimate variable, especially when talking about capital markets, and that's investor sentiment, trader sentiment, be that at the institutional level or be that at the retail level. All right. Right now, there is, since we've been doing publicly shared research, we've been doing research about 8-9 years now, but since we started publicly sharing some of our stuff about 5 years ago, investor confidence, trader confidence, capital market confidence, guys, are at numerical value metrics that we've never seen before. Okay, and it's kind of validation of our forecast that we made, call it what you will, is that there's some permutation of the 1980s here again, which is conspicuous consumption, materialism, capitalism, and all the stuff we've come to know and enjoy about life, about capitalism, right? So the point of the story, though, guys, is that variable alone, the sheer confidence and the sheer willingness of investors now to invest in capital markets, be that fixed income or equities, has never been higher. Okay? And that's, again, at an institutional level and a retail level, and dare we even say a sovereign level. All right, so that's what we're seeing. So that what we have here is a perception rally. We've used that plenty of times. What we have here going on, guys, is a perception-based rally. A perception-based rally combined with a ridiculous flood of liquidity, combined with a shift to industrialization where after market trading for 10 years on paper, effectively, all of a sudden starts to actually trade even this much on fundamentals like real economic expansion, real industrial productivity. Look at the mining industry, repealing a lot of the EPA regulations vis-a-vis Scott Pruitt. The building of pipelines, stuff that people can see, the building of the wall, right? Stuff that people can see. That is going to, especially when you've been numb to the fact that for the last 10 years, we're talking about almost purely paper growth, fiscal policy growth. Looks great on paper, doesn't really translate to the real economy. But what we're seeing now, guys, is a freaking perfect storm to send markets higher. And that's why for years, we know there's folks out there in 2015, it's the Schmida year. In 2016, it's the Smegma year. In 2017, it's going to be the Super Smegma year. It's like, oh, you have no fucking idea. No, the inflation hasn't started yet, guys. The combination of inflation, okay, the combination of onshoring liquidity, both corporate and personal, as well as call it the ultimate variable, if you will, investor sentiment. This is only the beginning of it, okay? And I've had the pleasure of speaking with a couple of our Evolution customers that have asked some really, really good questions about, like, well, how were you able to, at Dow, I think it was 2014, it was like Dow 14,000, 13,000, 15, somewhere in that neighborhood. They go, how were you able to say confidently that Dow had another 6,000 points in it? And I go, you're starting to see that now, all right? So that's where we're at, guys. Fed policy, like I said, Fed irrelevance is a very cool hashtag, and it's a very cool kind of headline for, for an article. But when you really start to see it happen, and that's what we're seeing, it really is, especially when you've made the forecast and you've seen the linguistics that we have, it really is pretty damn amazing. So that's what we're kind of starting to see the beginning of, guys, is that this is how the Fed loses control of its own currency, of the U.S. dollar. And we almost fell out of our chair laughing during the press conference. You hear Yellen go, well, we have an inflationary target of 2%. Talk about setting the bar low. I have no idea. All right? That inflationary goal of 2%, that is no longer within the control of the Fed. You can raise rates at this point to whatever you want. At the end of the day, the real economy, or the industrialized economy, and even the financialization economy, the so-called paper economy, okay? You don't get to have the strongest currency in the world and expect to be, competitive in a global economy. It just doesn't work. So U.S. economics, U.S. factories, U.S. production, whatever there is, okay, is going to demand that lower dollar. And historically, that's what happens. So again, raise interest rates to whatever you want. It's not going to change the fact that pretty much every other country on the planet is in the process of devaluing their own currency. I mean, China's kind of playing along. That was kind of cool. They're kind of messing around with the yuan a little bit. But at the end of the day, guys, it's a race to the bottom. There it is. So the analogy that we often use is with a strong currency, it looks great. It doesn't really do much when you're talking about a globally interconnected economy as it is now. But I said it's the equivalent of having a race car at a track that's 5 seconds a lap faster than every other car on the track. Upside, you got the fastest car on the track by 5 seconds. Congratulations. Downside, there isn't anybody that wants to race against you because they know they're going to lose. Okay? That's what having an artificially strong currency is. I mean, it's the best analogy that we have in the current financial paradigm. It doesn't really work. Everybody else is devaluing their currency. The U.S. dollar is going to have to go the same way. Otherwise, it's all going to come crashing down sooner rather than later. So that's what's going to happen, guys, because what we're entering now is a bit of a get what you can get while you can get it phase. And we forecasted this in 2013, 2014, okay? Preceding the implosion of any empire, preceding the implosion of a banking system. Read the Anglo-Western banking system, okay? There is that inevitable opportunity for the wealthiest amongst us to transfer wealth from the masses to themselves, okay? That's just the way it works. If you look historically, you can go back as far as the Roman Empire. You can go back even before that, okay? There is that window of opportunity, all right? And that's where you see your inflation starting, production. And it's just really, in the United States now, it's a perfect storm, okay, for that to happen. So what we're going to start to see now, guys, is based upon our analysis, all right, is the very, very, very beginning of what will probably go down in modern history as the single greatest transference of wealth in history. Okay, and that sounds all very dramatic and woo to say, right? But that's what's happening. This is the beginning of something we've said, again, since 2013, 2014. It's get what you can get while you can get it. Markets are going to be flying higher, and we said it. When you see metals and markets moving higher together, that's the first sign. And what a surprise, guys. We said Q3, Q4 2017. That ain't bad, okay? We're starting to see that now. So with that in mind, guys, again, this is a very macro overview, a kind of a quick synopsis summary of what's going on. We wanted to kind of get this out there because, again, we're not doing a lot of these videos, guys. We are perpetually now inundated with proprietary reports, a bunch of other stuff that we're working on, and we've been fortunate enough to take on 1 or 2 projects, guys, that are really going to represent flagship accomplishments for what we've built here. So we're really excited about that. We're also in the middle of about a 1 terabyte upload to the interested parties behind the Evolution system. So, guys, just a lot of stuff happening here. So thanks, everybody, by the way. Thumbs up and thank you for your patience with Wirehouse. We want to get that out to you guys. We're going to do that as soon as we're done recording this. We have the light now, so figured might as well do it now. But, guys, that's where we're at. This is really the beginning of get what you can get while you can get it. Now, how long does that last? We're working on that. We're working on kind of trying to put a time frame around it, but it's difficult, all right, because it's just economics have gone so dynamic now, and with the speed of information, it's just, it really can be difficult to keep up with sometimes. We'll be the first to admit that. But with that in mind, guys, again, thanks for watching. Of course, I will be on Dr. Janda's show again. I want to say April 26th. I could be totally wrong about that. I'll double check it. I'll pop it up on Twitter. But special thanks to Dr. Janda again for having us on recently. He had us on in February. It's very cool. Do enjoy doing his show. So there's that. In the meantime, guys, as always, if you would like to follow along, do follow us on Twitch, usually somewhere over there. It's not over there. Nah, there it is. Look at that. Things are back to working normally around here. If you want to follow us on Twitter, at Evo_consultants. If you want to email us, please do. We like hearing from you. Info at Evolutionconsulting.world. Info at Evolutionconsulting.world. All right, guys, as always, thanks for watching. Tried to jam a lot into this video. You know, the FOMC policy, guys, that was a major trend shift. I'm going to say it again for the millionth time in this video. That is validation of, we're pretty excited about it because it was just validation of so much research that we've done. So there's that, guys. As always, be good. Do remember that everything really is a transaction.